This Week in Money is archived online at talkdigitalnetwork.com.
Louis James is Chief Metals and Mining Strategist and Senior Editor of the International Speculator and Casey Investment Alert. He is online at caseyresearch.com. Louis, that's quite a business card you got there.
Yeah, it keeps me busy.
Welcome to This Week in Money, Louis.
Thank you very much.
You are just back from the PDAC, the Prospectors and Developers Association of Canada Conference in Toronto, the world's largest mining gathering this week. How did that go?
It was, as usual, a madhouse. It's interesting, though, because the numbers reported are that this was a new record, well over 30,000 this time, up over 27,000 last year. But it didn't feel crazier than last year. It seemed as busy. Maybe it was just that the mood was a little more subdued. Interesting times.
Why would the mood be subdued? I mean, gold is up, silver's up, everything's looking good. Well, what's the problem?
Well, it's funny that you put it that way. A lot of people don't feel that it's up. They forget that a year ago, gold was at $1,400.
Yeah.
And in fact, a week after PDAC, it had dropped below to $1,395. And here we are still maintaining prices that just a couple years ago were a dream for miners. But people are short-sighted. They often have a what have you done for me lately kind of approach. Investors are no exception. And the big kerfuffle last week, the $100 loss in one intraday period, really shook some people up. That's just chatter. Anybody experienced knows that. But people lose sight of the long term very easily.
Name of the game, of course, is funding. A lot of these people are looking for funding, and Bloomberg saying that that's going to be a problem for a lot of folks this year.
Well, it is and it isn't. In a way, this is market. What should we say? Or maybe we shouldn't say it nicely. The predatory aspect of the market here, showing that it is actually valuable. It's separating the wheat from the chaff. The good people, the tried and true experienced management teams with good projects, they're being able to raise money. You can see money right now being raised with no warrant even, or just a half warrant for a shorter period of time. And other people, less tried and true, less proven, are having much more trouble. There's been news of financings canceled and things. So the money isn't out there as easily as it has been in times past, and that has interesting implications. But it is out there for the right people. So the exploration's not going to stop. And if you're in with a good company, and good projects, good people, they will move forward.
We're talking to Louis James from CaseyResearch.com here on This Week in Money. One of the things that we've been talking about for the past little while, Louis, the disconnect between gold prices and gold producers. Gold producers obviously lagging. Here's a stat here. Gold more than doubled in the past 5 years, while the Huey has only climbed about 50% or so. Why is that?
Well, there's a legacy of underperformance in that issue. And to really move the majors in a big way, we need to have a broader participation of markets. A little junior that's trading at a few $1 million of market cap, it discovers something and it can go 10 to 1. To move the dial on the big companies, you need a lot more volume, a lot more people in there. And the costs have risen with the price of the underlying commodities. So really, until recently, we haven't seen consecutive quarters of record profits. I think as that continues, and I do believe the high price of these commodities, particularly precious metals, has outstripped the increase in prices that the producers are paying their costs, so that we should see more records. We are seeing more records. But, a quarter or two is not going to impress Wall Street and mainstream investors very much in the way that would really bring droves of new investors into play. I think that's ahead.
Okay. Let's bring ourselves up to date with what's happening with gold lately. It's bouncing back with oil and with stocks today. And, of course, we've had some good news from Greece, and Ben Bernanke kept his mouth shut this week, which kind of helped things all around.
Yeah, no, it's quite interesting, though really the fluctuations in the last couple of weeks have been, in a way, the opposite of what they should have been. Trouble in Greece, trouble in Europe, looks bullish for the dollar. Bullish for the dollar makes people sell gold because gold is priced in dollars, and generally people with I believe an outdated mindset see, what's good for the dollar is bad for gold. But this is not true. This is old thinking. And if you have economic trouble in the global economy, it may make the dollar win the race to the bottom for a day or for a week. The dollar hasn't actually gotten stronger than it was 2 weeks ago. It's only looking better than the euro. That's not a basis for dumping gold. That's almost literally insane. That's crazy. There's more trouble in the world, so you're going to dump gold? That makes no sense. So yeah, these fluctuations are tremendous buying opportunities. When something goes on sale for the wrong reason, you have to be a bit of a contrarian. You have to be willing to have confidence in your own judgment and say, I'm right, everybody else is wrong, and buy the dips. And if you had done that last week, you'd have made a significant short-term return.
What about this research report here from UBS? They say the possibility of QE3 is going to be the key to determining what happens next with gold. You think that's true?
Yes and no.
Okay.
Clearly, when the government signal massive new liquidity injections, that's good for commodities, and you can see that. And so when Bernanke didn't say anything about QE3 or something that looked like QE3, then gold sold off that day. But again, what the talking heads say and what actually happens are two different things. Really, the governments are between the proverbial rock and the hard place. They have no choice, especially this is election year. They cannot allow the appearance of recovery here to falter in any way, and they will do whatever they have to do. And whether they call it quantitative easing, though, is another matter. There may not be any big announcement, but there's ways that they can massage these things. So an example would be the recent sort of incestuous lending between the U.S. and Europe, helping each other out with their mutual bailouts. We don't call this quantitative easing, but it's still a massive amount of basically printing money out of thin air.
We are talking to Louis James from Casey Research here on This Week in Money. What do you look at the gold ETFs? They are a huge force in the market, holding almost $130 billion worth of gold. That has to affect what's going on, right?
Well, there's an interesting argument has been made there that one reason why the gold companies haven't performed as well as gold on a broad basis is because of the ETF.
Yeah. That
the ETF is eating up the consumer demand for gold stocks. I think this is actually incorrect. There is something to it. Obviously, it's easy for people who want to play gold to buy the ETF, and it's very liquid. It's like buying gold itself, but on your day trading account with E-Trade or whatever.
Okay.
So yes, there's something there, but you have to remember that the reasons to own gold are very different from the reasons to speculate in gold stocks, and broadly speaking, the metals and commodities along these lines. You buy gold for prudence. You buy gold because you're worried. Gold is the ultimate safe haven, right? But you don't buy little junior mining stocks for prudence or for safety. You buy them for their speculative upside. You buy a company that has an almost insignificant market cap, and it discovers a multi-billion-dollar deposit, and the thing can literally go 100 to 1. That actually happens in our sector. That's why people buy the stocks, and you're not getting that from the ETF. So that hasn't changed, and I do expect these commodity-driven stocks to deliver as they have in the past as we get to the real mania phase, which has not happened. These people who say gold was in a bubble, I believe, are missing the overall situation here.
Gold dropping below its 200-day moving average this weekend. Perfect timing here. Jeff Clark is writing at Casey Research. Time to accumulate gold and silver, and it makes a lot of sense.
It does. His analysis in the most recent issue of our free newsletter, we have a free daily newsletter, actually, but every Monday it focuses on metals and mining. And Jeff did something that, frankly, I never would have done. He looked at the chatter, and we call the daily fluctuations chatter because they're generally meaningless. And it's funny, if you ask our boss, Doug Casey, on any given day, he may or may not know the price of gold because he really doesn't look at the daily fluctuations. He looks at trends, he places his bets, and he waits until he's right. So to look at the daily chatter was a strange thing for us to do, but what Jeff found was that the pattern in the chatter was visible as you approach the big manias in the markets. You can see the chatter increasing. You can see the volatility increasing, in other words. And placing things in that context, and of course history never repeats exactly, but still, looking back at the pattern of chatter leading up to the spike in 1980 in gold and silver, you can see that we're at nothing near those levels. We're also, the big fluctuations in the last week are not the biggest fluctuations in this cycle either, by any stretch of the imagination. So much ado, not about nothing, but much ado about really a small bump in the road.
As you touched on earlier, Louis, one of the things we really have to focus on is what gold does for us as compared to what our fiat currency does. Here, we've got a great stat here from Jeff. Both the U.S. and Canadian dollar have lost about a quarter of their purchasing power in just the last 10, 12 years.
Yes, it's quite striking. And if you look at the comparisons, if you look at inflation-adjusted terms, gold still hasn't beaten its 1980 spike. And you look at how much the fiat currencies have lost since 1980, and it's kind of depressing. That's not just looking back 100 years or to historical records, but just in a generation, what's happened to the fiat currencies. It's you wouldn't have believed it if you hadn't lived through it.
Mm-hmm. Now, even Doug Casey doesn't have a crystal ball. He can't look forward into the gold market. So we're just going to kind of guess what you see happening. Obviously, with all the news and the headlines, it's difficult to believe that gold will go down. What do you see going forward in the near term for gold and silver?
If things continue as they're going, I would expect to see more or less gold trading sideways, the metals trading sideways. There's enough fright in the world, and ultimately, I don't see gold driven by supply and demand. It is not an industrial metal. It's a barometer of fear in the world, and there is enough fear that's been generated by the great calamities that we've seen in recent times that's just not going away very quickly. So even if things continue seemingly improving, they've just announced the New Deal in Greece, so yay, Europe is saved, everything is all fine. In the United States, there are signs of recovery, unemployment is down, Obama has saved us all. It's happy days again. Even if that were true, gold is not going to go back to $300 an ounce in a few months.
Yeah.
It's just too much has happened for people to forget their fear, for the sphincters to unclench, and things to go back to the happy train that we were on before. But of course, things never continue as they expect. There's volatility in the Middle East. Who knows when the fuse will actually hit the keg in South Africa?
Yeah.
There's signs of China potentially being in trouble. The new projection of 7.5% GDP growth, their new target in China, that may not sound like a big deal. The 7.5% GDP growth is huge compared to Western economies. But my sources in China tell me that anything less than about 8% can lead to serious social unrest in that country. 7.5% is their lowest target, and I don't even know how long.
So for them, that's pessimistic.
Stuff.
Yeah, for them, that's pessimistic.
Yes, it is. It is. It's very pessimistic, and of course, you don't hear about all the riots and problems that they have because this is the state-controlled media. But if you know people in China, you know these things are happening. So again, there's plenty of cause for concern. And with that sort of thing, I don't see the fear barometer of gold going anywhere substantially lower in any near term. And of course, the things that the governments of the world have been doing to paper over the problems and to try to reflate the economies are ultimately bullish for all commodities, including gold. So, I am a bull. The worst case scenario I can see is actually if Doug Casey is right and there is another big kerfuffle, if the other half of the W has not actually been postponed that long, and you get another 2008 style crash that's both deeper and longer lasting, everything gets hit, right? People need cash.
Yeah.
They get their margin calls, the funds get their redemptions, and so on. So even gold would take it on the chin under that circumstance, but only short term. As people hit the bid on anything they can sell, they will sell gold simply because there are buyers, whereas there are not buyers for the condos they foolishly just bought into or whatever. If that happens, that's almost the best possible scenario for newcomers to the market because you can see lower prices than we've seen in a long time. It's maybe the last chance to back up the truck for both the metals themselves and the stocks.
Louis James is senior editor of the International Speculator and Casey Investment Alert. He's online at CaseyResearch.com. Louis, thanks for this.
Sure, you're very welcome. Pleasure to be here.